Hello and welcome to the ByteTree third quarter webinar. I'm Kit Winder, the analyst here, and I'm joined by our CIO and founder, Charlie Morris. To frame the conversation, we're going to start with a presentation, which will be mainly on the multi-asset investor, the Whisky and Soda portfolios, and broader themes. And then we'll touch on a couple of the other services as well. And then we'll finish with Q&A questions. So do send in your questions during the presentation if you have them. We've got a couple from the build-up as well. But finally, before we go any further, just to say, none of this should be taken as investment advice. So Charlie, I think now we can hand over to you for the presentation.
Thank you, Kit. And I think that you're probably seeing a bit more of Kit publicly at ByteTree now, and he's a very welcome member of the team, and he's doing great work on the quality product, which we'll touch on later. But for those who are new to ByteTree, we do lots of very good, high-quality investment research. And to touch on the main products in traditional finance, today I'm talking about the Whisky and Soda portfolios, which are the multi-asset investor. The soda portfolios medium to long term, the whisky portfolios medium term. One's balance, soda's balance, whisky's equity, benchmarks against the FTSE. It trades a lot more than the soda portfolio and has different fulfillment. So please have a look at those in your own time to make a judgment. The quality portfolio on the right is long term, it's global, very low turnover in global equities with a low to medium level of risk. And on the left hand side, we've got a much higher risk, much faster, more of a stockbroker service with regular ideas every Monday. So that's really what we do on the TradFi side of the business. But at ByteTree, we also do other things. There's some pre-reports. Yesterday, I wrote Atlas Pulse, a monthly on the gold market, very topical at the moment. We'll get to that. And I've been writing that since 2012. The Bold report on our Bold index covering Bitcoin and gold. If you do own those assets, then you should be rebalancing them, and the Bold report tells you how to do that. Then the other report we do that's free is the GTI 200 on the global technical state of trends in global stock markets. A very, very good report and really excellent value since it costs no money and takes a huge amount of our time. On the premium side, there's also a spreadsheet that looks at the 2,500 leading stocks in the world. Rashpal and Robin cover off the adaptive asset allocation report. That's ETF trends, major ETF trends in stock markets with a model portfolio. And then finally, we've got ByteFolio, which is the same sort of thing with a sensible hat on and approach to digital assets. And there's a model portfolio that's been running for about 3.5, 4 years. Finally, of course, there's our Bitcoin and gold ETN, which is coming to London soon, and we'll touch on that. Now, just about to get into the meat of the presentation. Forgive me for doing my promo first, but you can buy packages. There's a multi-asset letter and quality for 49. That's a £10 saving. You can also have the momentum side of it, which is really for professional investors, more sophisticated investors, and that's a discount at 79. But then the real bargain, which is unbelievably cheap, is 99 for everything we do. Okay, on to the presentation. So we'll kick off with what happened in stock markets in this year to date. I think it's a bit tedious to look at the last 3 months. And, surprising, the colors, there's some sort of color blindness on my slide, but I promise you that's America, that's Japan, that's all the others, emerging markets, Europe, and emerging markets in Europe, basically. And then finally, we've got Bitcoin here, and then we've got gold there, which have really led the market this year. Gold is really on a tear. We'll come to it later, but it's rare that this happens. But I would simply say we should be enjoying it while it lasts. And I think there's lots and lots of opinion on whether we've got too much, and some of our clients think we've got too little. And so there are different things, but there are good reasons for that. The shift to alternative assets this year, but basically we've got America lagging, which has really floated the boats elsewhere, and I think that's a major reason why Bitcoin and gold are doing well, as US equities, people are looking for alternatives. And that's buoyed Japan, where we have a strong position. And we've got a new prime minister just this week, the first lady prime minister in Japan's history. That's quite exciting. She's thought to be a money printer, but that money printing will obviously keep global stock markets going. So we shouldn't be too worried about that at this time. But I think that the Topics index probably has made a major low earlier this year. I think, in my opinion, in February, that was the all-time low relative to the world index. And so far, that's turning out to be correct, but it's not exactly racing off quite yet. But the obvious place to take your money has been places like the UK, Europe, and the emerging markets. And the emerging markets are a mixed bag this year because whilst India's been the leading market for quite some time, this year it's really or since mid last year, it's turned to China. So that's a little bit of the background. Bonds versus equities. Bonds are very, very topical because we have a government debt crisis. We have unsustainable deficits at a period of time when we've got very high debts. It's okay to have a deficit when you've got low debt because that's fine, because it's temporary and you know that it's going to, the books are going to be balanced. But we seem to be in a world of structural deficits, particularly in places like the UK, USA, France, and some others. And it's causing real concern whilst debt levels are really ballooning. So the red line below shows you the difference between equities versus bonds going back 50 years. And the last time we had a rally on this scale was in the 70s. And by the way, the last time we had a rally on this scale in gold and silver was in the 70s. So there are some conclusions to be made there. And we've got the Q&A later, so please get your questions in for that. Then I highlighted a couple of charts in my recent quarterly review. This one looks at market cap of global equities in black against the global money supply. That's an estimate of the M2 of the top of the G20, which is basically most of it. And on that basis, we can see that the stock market is a little bit ahead of itself, probably worryingly so. But there was something mad back in 2007. And I would probably go back to 2007 and highlight that the Chinese banks came to market from nowhere and they listed, and they all listed on sort of 3 to 5 times book when the, and all of them were sort of 4 or 5 times bigger than HSBC, JP Morgan at the time. Which is a bit of alarming. So there was some crazy things happening back then, but still, we've got to be wary of the fact that the value of equities globally is once again comfortably ahead of the global money supply. Same sort of idea, but this time we're going to look at equities against the world market cap of equities. Sorry, I've changed the colors. I realized I was in black last time, but this time we've got market cap in purple and global GDP, nominal GDP, which is the real growth plus the inflation, and that really is at quite alarming levels, up there with 2007 and pushing on to 21 levels. 2021, of course, we had a big surge, not just in equities, but also in nominal GDP because of the inflationary episode that we have during the pandemic. The size effect has been very important in the last few years. So this started as the UK equities starting in the middle of 2021. And at that time, we had obviously a peak. And since then, the FTSE 100 has done very well. And the AIM stocks have turned £100 into 100 pence into 60 pence, whereas mid caps and small caps are somewhere in the middle. And it just reiterates it's really been a large stock market, all about liquidity. And so, not many points for seeking out junior stocks and so on in the recent environment. Big is beautiful. And in America, that's even more profound. Going back 10 years on the S&P 100 in black, the 100 biggest stocks in America, then the 500 biggest stocks in America. Confusingly, the 400 is the 500 minus the 100, and the 600 is the next 600. So it's a funny old thing, but basically, the bigger you are, the better you've done. Highly unusual. I mean, anyone who's studied markets over 100 years or so would tell you that the big cats don't perform. But we're in an era where that's not true. Other eras like this were the late 60s, early 70s, obviously the late 20s, the late 90s, and today. We know what it means. We know the risks. Luckily, we don't own many of these stocks, so that's a good thing. But still, there's no way around it but to say that we are in a heady market. And then I'm going to hand over to Kit, who's going to take us a little bit about the sort of dynamics between high and low risk investing.
Yeah, so the chart here, the red line is high beta stocks, which means when the markets go up, they go up by more, and when the markets fall, they fall by more. And the blue line in the top panel is low volatility stocks. So these are sort of things like Unilever, large, global, diversified, very steady, whereas you know, if you want to know what high beta is, 3 of the top 5 companies for beta in the last year have been Nvidia, Broadcom, and Novo Nordisk. So you get a sense of what the two groups are. And since the pandemic, since the lows of the post-COVID crash, high beta stocks have quadrupled. So from 1,000 on that graph up to 4,000, whereas the low volatility stocks are only up 60%. So that's been a sort of remarkable outperformance. And really, the last time we saw anything like it was the dot-com bubble back in 2000. And you can see there the red line crashing right back down, and low volatility stocks sailing through pretty calmly indeed. And if we go on to the next slide, we can tell you why that's important, which is that in August we launched the ByteTree Quality Portfolio. Quality is low volatility, it's predictable, it's steady, it's safe, it's reliable. It might underperform slightly in bubbles, but it'll outperform in the difficult times. We've recommended 5 brilliant companies already, and we're on our way to building maybe a 24 stock portfolio by the middle of next year. There's sort of 3 major things going on, which is we see a timing opportunity from the recent underperformance. And then we also see a long-term opportunity, because on that last chart you saw they've matched the high beta stocks, but with a much smoother ride along the way. And the final thing that we see elsewhere is maybe quality portfolio managers not caring enough about things like valuation or momentum, which we're going to incorporate very carefully into our strategy. So we see a great long-term opportunity backed by a short-term timing opportunity, and a possibility to differentiate as well. So that's going to be very low turnover, focused on companies with sustainable, profitable growth. Charlie will be managing the portfolio. I'll be helping out with the company deep dives with the research. 5th stock was published today, and yeah, as you can see there, low price, lowest of the ByteTree services at £19 a month.
But Kit, you're worth it. Okay, gold and silver. Don't worry, ladies and gentlemen, I have silver live on my other screen, and it's above $50. So that's the first time since 2011, and then going back to 1979 when we last saw that. So a very exciting time for the silver bugs. Gold's obviously $4,000 above. And, I think this is really, really important. One of the things that I'm watching are the sentiment indicators around this. Now, no bull market goes up in a straight line. The run we've had in gold for the last 2 years has been exemplary. I do expect pullbacks at some point, but it just feels very, very early for this to be some kind of major top. You may recall in 2020, I wrote a piece for the LBMA, the London Bullion Metal Association, forecasting 7,000 gold by 2030. But we're already at 4,000, so that's feeling a bit limp, and we'll probably have to upgrade that. But I think the sentiment is going to be really, really important in seeing when the market is overdone. It is slightly overbought, as I pointed out in Atlas Pulse yesterday, about 25% above the gold, about 25% above the 200-day moving average, and the market is sort of heating up. But the gold-silver ratio, something that goes back thousands of years, is a very powerful idea, and it really sits the sort of modern gold and silver, which is 21st century thinking. We've got a ratio at 80, basically 81. It says on the chart, but actually it's 80 today because silver's gone above 50. So think about that: $5,000 gold, $50 silver is 80 times. And normally you would expect silver to shoot past. And that would be top of the market. And the silver market's only really just started getting going, as you can see in the last few months. We had that lovely cup and handle pattern in the silver market, which the gold market did have before, and off it goes. So I would expect that to come well below the red line before we start worrying about this market going too far. I think the reasons behind it are very strong. And that is that there's a lot of uncertainty in the world, and people don't trust the bond market. As I said earlier, I'd love to buy lots of bonds in the portfolio to keep them safe, but I'm not sure that they are going to keep them safe. So that's one of the questions that we have to ask ourselves. And then just to touch on the miners, this is a 10-year chart. I did publish an Atlas Pulse, a much longer term one yesterday. But quite simply, this gold bull market is 10 years old, as in when the low was. The low was in 2015, end of. And so this 10-year chart just captures that period. Now, the gold miners managed to get to 80% above the gold price back in 2016, and there was barely a rally. So that was just saying that they were too cheap at that time. And we've also tested that level after the 2020 peak in the gold price, where the miners sort of thought, well, maybe we'll start making some money again. And then we've touched it again recently. And so, these 2 points are not major markets, major peaks in gold bull markets or anything like that. And we're only at those levels relative here. And we're supposed to get lots and lots of leverage from the gold mining companies in a gold bull market. And so far, we really haven't. So, if you start the chart around here or something, we've only just started a little bit of outperformance after one hell of a lag. And the other point is that the value of the gold ETFs and the gold mining ETFs has gone up a lot, but the amount of money that's gone into them hasn't. So this rally is all about price in a very tight market, driven by the central banks, driven by uncertainty, and driven by the need for diversification in a questionable bond market. So I don't think we should panic yet. And I'd much rather, we run this market and then and reduce exposure when things start to tail off, rather than try and guess the top and miss the next double. That's sort of how I'm feeling at the moment. But risk management will be important, and we will be rebalancing at some point. Touch on Bold. Bold's coming to London soon. I'm very sad to say I don't know when. You have no idea how frustrating that is. We don't even know when the Bitcoin ETFs are going to start trading in London. The ban was ended yesterday, but we have no idea when the first day of trading is, and that's from the inside. So forgive me, but I get a lot of emails about when Bold's coming to London, and I simply don't know. But on Bold, it's a very effective thing, because if we are worried about gold, then having a little bit of Bitcoin in the portfolio is a good thing, because as you can see, whenever gold has stalled in the past, Bitcoin's tended to do well, and vice versa. There's a very natural low correlation between these assets. And I think the simple way to illustrate it is that Bold on average has had about 25% Bitcoin, 75% gold in the last 3.5 years. And yet the price of Bold is in the middle. It's not here, it's here. And so there's definitely a positive force and a very smooth ride by owning these two assets. And I'm firmly of the belief that, that certainly, whilst we're in an inflationary environment, these two assets are highly complementary against each other. I mean, just look at these sorts of things, gold down and Bitcoin goes, and then gold stops and Bitcoin goes up, and then it stops, and it keeps on happening. Okay, onto the portfolios. That's the near 10-year record for the Sober portfolio, some outperformance. I think that you've done very well to bear with me over the last few years, where it hasn't all been plain sailing in soda. Going to the annual discrete performance, there was a very strong year in 2022. That was a down year for the stock market and for the benchmark, where we actually made a bit of money, having huge excess return. But then I managed to give all of that back the following year, essentially by not owning the FANGs, or the Mag 7, we call them these days. And the other thing would be that funds like Ruffer and Capital Gearing kept us under a bit of pressure with their bond portfolios, but it's been right to hold on because they're starting to perform well now. And I would also add that the discounts for some of the investment trusts were pretty stubborn back in 2023. So think of those of cancelling each other out, and then the last 2 years cancelling each other out. So we're on benchmark since about 2021, which I'm not thrilled about, but I think long term it is good. And we have taken less risk. So the benchmark is 7.7, 6.4% volatility over time, with a slightly higher return, meaning an outstanding Sharpe ratio. So you can't eat a Sharpe ratio. I do understand that, but it does demonstrate that if things were to go awry, then the portfolio is well diversified. I would say better diversified than the index by design. There's Whisky. What a year we've had. Yeah, it feels lucky. When gold and silver and gold mining stocks and things like that just take off, then you think, well, they deserve the credit. But I think the portfolio has been okay. Other than that, we would have still been had a good year without them, because lots of the stocks have done pretty well. But really, the excess return really kicked off in 2020. And if you're guessing, well, why didn't you outperform massively before 2020 and you did after? Well, I think it's because ByteTree became my full-time job after 2020, and before that I was in the city with, and it was a part-time job. So I think that's probably one of the reasons. But still, the performance before then was perfectly respectable. But also, I'd say that UK equities in the pre-2020 years were going through tough times, and there weren't many winners to choose from anyway. But really, since then, it's been a very solid move. And again, looking at the discrete years, I think we had a bit of a the year I regret the most is 2016, because I just started doing this, and it was the biggest momentum crash in the 10-year period, and I just was far too slow because I was new to the job and didn't really know about it. But that should have been 100. Whisky should have made 100% in 2016, if I'm brutally honest. Maybe not quite 100, but that sort of thing. But then most years we've had outperformance, very good in 2020 because we were defensive and thinking a bit differently from the benchmark. And we're quick to sell when things started going wrong, which is a very, very important thing to do. We did it again this April, and I got some criticism from some clients for that. But you just don't know when the market breaks whether it's going to be very big or shallow and rebound. This time it was shallow and rebound, but the next time might be different. So I think it is right to be defensive and act when things change. Once again, we've got a solid 15% annualized against 9 for the index. Slightly more volatility, but not much at all. But again, a healthy Sharpe ratio. As volatility goes up, it gets harder to generate high Sharpe ratios. And that brings us to Q&A. So we're at 21 minutes. There's plenty of time to do that. And so please get your questions in. And we've got quite a few that have already been sent in. So we'll kick off with those, get them done, and or you can mix them in as you wish, Kit.
Yeah, brilliant. We've had some before and some during, so I'll mix those in together. The first one is from before, is to ask whether, Charlie, you've ever tried to track your performance, not for the portfolio as a whole, but by the distinct categories that you lay out. So equities, bonds, precious metals, and friends. So that would be to measure your equity portion of the portfolio against an equity benchmark and the precious metals against the precious metals benchmark. Have you done that? How does it look? Is that possible?
Yeah, it's possible. It's complex, but I don't think it's that relevant, because what's more relevant is the fact there hasn't been a precious metal book for many of the years that I've been doing this. I mean, I turned bullish. So thinking about this and my career before that, I turned bearish on gold in 2013, and we barely had any exposure at all. And I think I added a little bit of gold mining as a trade in 2016, and then we barely owned it or had a very small position. Only started to load up post 2018. And one day I could see a time that I won't own any gold at all. So there isn't a permanent fixture of a 30% gold portfolio. That's not how it works. You don't want to be in an asset that's irrelevant, and obviously gold at the moment is highly relevant. But onto the other sections, they move, don't they? So sometimes there's lots of direct equity, sometimes there's less. At the moment, there's only 2 ETFs for, we've got the China tech and we've got the biotech, but there could be many more of those. So things change, and I think the point about the portfolio is it's diversified and it's flexible in many different senses. And I do stick to the thesis of the money map. I'm not exactly, but we are underweight quality. And I suppose that if we go to a downturn, that's where we want to be. But you don't know what the next downturn is going to be driven by. So quality stocks obviously offer very good value these days, and that gives them a lot of insulation under any event. But if we get an inflation crisis, then it could be that the safety is in steel stocks or something crazy like that. So we have to be flexible, because we don't know what the market's going to do next year. But diversification is the one free lunch we have in investment.
Great, thanks, Charlie. Next one is that obviously gold and mining have been on quite a tear recently. When the time comes to rebalance these assets, what other things, what other assets, or what other stocks are you thinking might be less impacted by a fall in gold? So where would you find safety if gold were to turn?
Well, there's why would gold turn? One is they fix the world, and we no longer have deficits and fear and that sort of thing. Seems unlikely. It could fall because it's too high, but doesn't have to. It could go up and stay up. Or it could be that this was all nonsense and it was just a bubble and it was all a bit of fun and part of the sort of modern high vol era of investing. I don't think that's very likely, given that it was led by central banks. But I think that there will come a time when gold will run out of steam, and on a risk-adjusted basis, let's say it's going to a much higher number. As you get close to that number, it doesn't matter if you get out a bit early because your risk-adjusted return is lower. If you've got less upside, then you don't need to hold as much. And so, I do think that we'll fade that trade as it gets out of hand. But the other point is, where are the opportunities? I mean, 2 years ago, there was these bargain basements in UK equities and small and mid caps and things like that. And particularly in the venture portfolio, we took advantage of that. But now, you sort of look around and you're seeing it's so obvious that the next big buy are quality stocks. I don't mean to sound like a sales promo for quality, but the Whisky portfolio will have higher exposure to quality when this thing turns. I think it's inevitable. That would be I think a downturn, because downturns are disinflationary, and that will drive them. So I think that that's probably the simplest answer, given what I know today, and there's a very uncertain future. Yeah, but that's what I'm saying. We're going to do more of that. There's a possibility of index-linked bonds. I mean, I know at the short end they're fine, and we've done that a little bit. But the long end does seem like a powerful opportunity at some point. But then you've got to trust the government to keep a lid on those yields, and that's far from certain.
Very interesting on quality there, because there was another question on whether the thesis behind quality portfolio launch was that there will be a rotation into it, or simply that it was about diversification. But I think you've tackled that now. So I'm going to move on and ask you about government bonds in third world countries. That's a sort of specific question on something that you might be interested in, because they have low debt levels and stronger economies, while we're seeing often in developed Western economies that they have slower economies and higher debt levels. So is that sort of, I guess, divergence something that you're looking at?
Yeah, so stronger economies. I mean, they've got higher GDP growth, which is not quite the same as stronger economy, I suppose. The good ones have low inflation, and the good ones have low debt levels, and emerging market debt as an asset class is outstanding. It's a fantastic long-term thing to do. I would say that between 2001, 2 and 8, there was a big, the dollar fell by a third, EM currencies rose across the board, yields started off very high in 2002, 3, and they were compressed all the way into 2008. And so you had this triple whammy of, of the bonds coming down, the macro getting better and the currencies going up. And that really was fantastic. Now, I don't think it's quite as good the setup again today, but I have huge respect for EM debt as an asset class. But it's got to be actively managed. We tried that ETF a couple of times, and all the actively managed funds are basically hedge funds. They're complex. You're not going to be able to buy them on Hargreaves Lansdown. If I'm wrong, please, someone send in a good idea on that. But we can't be doing with hedge funds and weekly dealing and complex instruments and minimum investments of 100,000 and all that sort of thing. So I just don't think they're investable for most UK retail investors. But it is a great asset class to own over the long term if you've got a good active manager.
That brings us on nicely to the next question, which is about rougher and capital gearing, RICA and CGT. Someone writes in, during approximately the last 4 years, we've seen RICA and CGT underperform inflation. Given financial repression, would we be better off with the funds invested in inflation-linked gilts and bonds, turning back to RICA and CGT if and when financial repression ends?
CGT, that's a very interesting question, because CGT and rougher, their biggest holding is inflation-linked bonds, and that's what's caused their underperformance. So their performance actually massively outperformed a sort of lazy investment in the bond market. They kept their debt short by and large, and we went through an era where real yields, real interest rates went from sort of -3, depending on the tenure, but -3 to +3. I mean, it's absolute carnage for inflation index-linked bonds on both sides of the Atlantic. And and I think that the problem was that the inflation was seen to be transitory after all. It took time for that to become true, that J. Powell statement. But the inflation went up, it came down. Now it's not down to 2, but it's it's hanging around 3, 4 in the developed world. But the long-term inflation expectations are still at 2. So the bond market doesn't think inflation's a problem. Gold disagrees. So we've got this extraordinary dilemma in markets of what it is. What is inflation going to be over the next 10 years? And you've got two answers, whether you listen to tips or whether you listen to gold. I mean, I think that the instinct of these policymakers is going to be to print money and take the easy route. The right thing to do, of course, is austerity, but no one likes that. You lose elections with austerity, going back to Russell Napier's financial repression and that sort of thing. So I think that CGT and RUFA are outstanding fund managers. They've got a mandate that's low risk. If I didn't own them, who would I own? I'm not going to increase the risk in soda. That's not the point of a soda portfolio. It's supposed to be a highly resilient portfolio. If you want more risk, have less soda, have more whiskey. That would be my answer in your blend. But they're outstanding. I mean, I think that Peter Spiller and John Ruff are the two of the people I hold in the highest regard of the city. And I'm pleased to see that the Ruffer portfolio is actually up. I did see the manager 2 weeks ago. Yeah, I have faith in them.
Perfect. And just on...
I would say, Kit, though, they did start at 20% of the soda portfolio and they're both down to 12. And their performance has been the same. I mean, the same.
Yeah. Just because you touched on it there, someone's written in and asked, obviously, about the rebalancing that's so powerful in bold. They wondered whether you ever considered incorporating anything like that into soda and whiskey in terms of how to weight them and how to rebalance them.
I'd love to. It's a real pain. Rebalancing is a real pain, particularly in publishing, in the environment we're in. If I ran a fund and just rebalance something, everyone would be going, oh, great, thanks. But to actually instruct everyone to sell this and do that, and then you get a tax bill if you're outside of a SIPP or an ISA in your investments, and it's a sort of, it's a good risk management thing to do, but it doesn't add any value. The reason it works so well in gold Bitcoin is because they've got very low correlation. And so you've got one racy asset against one calm asset, and they have low correlation. That's why it works so well. And you get a huge payoff from rebalancing in those two. Do you get it from bonds and equities in this day and age? I don't think so. And if you did it between gold and silver, for example, you get no benefit. You get no benefit from French and German equities. You get no benefit from equities and bonds pretty much these days. So, you do need to have a very specific asset pairing. I think if we had a portfolio of NVIDIA and Unilever, that might work. But we haven't launched that yet. Maybe next year, Kit.
Yeah, maybe next year. It's a good idea. One thing that's gone unmentioned so far in this conversation is oil and gas. And obviously, we've talked about how high gold is going. Low oil price is a boon for the miners as it's their major cost. And there's been a little bit more interest, I guess, in traditional energy coming through in GTI. Where are your thoughts on that at the moment?
So I think that energy stopped falling. That's probably why it's perking up in GTI. And there's a lot of value in the energy sector in general. Obviously, UK small cap energy is political. So I'm not really talking about that. I'm talking about more mainstream. You get big free cash flows yields in these stocks, but there's no growth. And I think that, annual oil consumption does rise, but it's not really rising fast enough to get excited, and supply seems to be coming through faster. So they seem to, you put a hole in, oil seems to be popping up everywhere. And the whole sort of 2000 peak oil thesis is really not happening. And then you've got the EVs in China and elsewhere, which is also reducing the because oil's a transport play mainly. I get that oil's dirt cheap, and we still have one little stock in whiskey, just to sort of remind us that that it's there, and I suppose it will probably be quite resilient in the downturn because no one owns it. It's one of the key things about what to own in a downturn is whatever people didn't buy in the upturn. I think that's another thing, quite aside from fundamentals, volatility, PE ratios, and so on. It's if it's under-owned, then it's going to be more resilient than if it's over-owned. So understanding that positioning is very important as well. But yeah, oil. Oil's on my list every day of key things I look at, and it never goes up. At the moment.
At the moment, another sector that someone's interested in is property and REITs, both in the UK and abroad. Another sort of alternative sector, maybe looking for safety again. Yes.
Well, it's a rate play, isn't it? And the correlation of commercial real estate prices and bond yields is very high. So we started buying into TR property, didn't we, about 2 years ago? off my memory, and we added to it. And I think that I'm very happy to keep that for the long term, but I can't get excited about it quite yet. But I think the bear case for commercial real estate was quashed when the working from home really reduced. Certainly, using my local railway station as a benchmark, the office must be quite full today compared to where it was 2 years ago, and definitely 4 years ago. So it's hard to get a space later in the morning when you try and book the chairman's train to go into London to have your lunch. So you have to think about that in advance. But it's I think it's probably fine. It probably is quite a good place to ride the storm, because if you've had the correction which they've had, then that's a good thing. But then you have to worry that if we found the true price of government borrowing, without intervention, manipulation, so forth, what would that be? What would the borrowing rate be? But in favour of the property sector these days, they are deleveraged. You're not seeing big debt with these companies. It's all pretty manageable, and occupancy seems to be pretty high. So, yeah, I mean, we own some, but maybe we should own more. That's a good thought.
Right, we're 35 minutes in, but maybe just a few more questions if we've got time. One of them is back to the services. Someone says, I've started to track your soda portfolio. I'm looking to add some whiskey, but I'm wondering how I should incorporate ByteTree quality. Can you suggest a split of how that would work?
So I say this, we have lots of products. If you go to Jupiter or BlackRock, they've got millions of products, and you don't go in and say, how do I own all of them? So that's the first point. It might sound flippant, I don't mean it to, but I'm just making that point. We are a business and we have different products doing different things. The whiskey and soda portfolios are fine, so you can live on that. You've got loads of safe money. The idea is you have 60 to 80% in the soda portfolio, so you're doing a very calm portfolio aligned with the investment management industry generally. Hopefully we're doing a little bit better, definitely on the risk side. The return side, not so much in soda recently, but hopefully that will come back. If bad things happen to the American stock market or something, then we'll start to show huge outperformance. That's the sort of thing that would really work in our favor, at least on a relative basis. The whiskey portfolio is always going to be continuously managed and updated. And it will be sometimes high risk, well, not high risk, but medium high risk, and other times have much less risk. And there have been times when it's had quite a lot of cash, and that will happen again at some point when the opportunity is not so clear, or the risks have increased rather in the markets. Now, qualities something you can do alongside. Now, first, it's global equity, so you're always invested. So in a bear market, you'll go down; in a bull market, you'll go up. The difference between quality and something like whiskey is that in a bear market, in quality, you'll go down much less than the market, and in a bull market, you might lag. The net, hopefully, if we're doing a good job, is to outperform over the cycle, and so you should get an excess return from a good quality manager by compounding at a faster rate. That's what it's all about. Now, if you want to incorporate that into your whiskey and soda, absolutely a good idea. And I would say, you'd probably want to have about the same amount as you have in whiskey. And if you did bring quality into your portfolio, then you could probably shave soda back by the same amount. So let's call it, let's say you're 80-20, to be 60-20-20 would be fine, I think. Intuitively, that sounds about fine. But I think that the even better answer to the question is the soda portfolio, probably half the equity should be quality. So the 60%, probably half of it could do that. That's the other way to think about it. Now, we use collective investment schemes, which are highly diversified. So they're probably similar risk. But I think that is something that I've thought about for the future. Should the soda portfolio have quality stocks in it on the individual stock level? And I haven't done, because I just try to keep it simple and low turnover. And investment trusts and ETFs are probably a simpler way of getting there. But certainly it could do.
Certainly could do. All right, well, two more. One is on interesting countries. That is, do you ever consider investing in countries where the stock market has taken a great fall in the past, e.g. Argentina or Greece? And I would add maybe China to that list as well, which after a great fall has had a good year, as you mentioned earlier.
Well, we've owned Greece. I can't remember which year it was. It was about 2016 or 17 or something. We've owned Pakistan. We've owned Turkey. We've owned Philippines. What else have we owned? I would have owned Argentina if we could, but there's only an ETF in America, not one in Europe. Yeah, absolutely. I love just, EM countries on the turn. It's been one of the things, and indeed the countries that are interesting at the moment along those lines are places like Thailand, Indonesia, Philippines, Malaysia, which has been sort of Asia ex China has just been really left behind. China, Taiwan, Korea, those three giants, and then all the other guys have been left behind. So they're probably quite interesting places to look at. But yeah, absolutely, we do that sort of thing. I mean, that's what the ETFs in Whisky are there for. At the moment, it's biotech and China tech, but we're always looking around for ideas there. But that said, I would say, Kit, I do try and keep it, as many direct equities in there as possible. I do think that people like them. With gold, direct equities concern me because, I'm happy to put them in venture. But, I'd be so irritated if I chose some gold stock and it didn't do what you wanted it to do. So to buy the basket is just so much easier as a decision. Because it would be infuriating. You got the wrong gold stock and that was a key allocation to a rally and you missed it. I'd be furious. I think just owning the basket of gold is so sensible. It just solves so many problems. The gang are going to be fine. You don't really need to beat it. It's more of a question: should you own the gang or not?
Should you own the gang or not? Well, I think that's a pretty good question to end on, given where gold and silver are today. But yeah, I'm sorry if we didn't get to your question. There were, in the end, quite a few that came in. I think we got to most of them, or at least covered something very near to what people asked. Charlie, thanks for the presentation and for taking on so many questions. And to everyone who watched and listened, thank you for taking the time to tune in. Thanks for sending in such great questions. And we hope you enjoyed it very much.